An oil market storm brewing, unseen risks and potential fallout. Despite the oil market's current calm appearance, a perfect storm of factors is brewing beneath the surface, threatening to disrupt the industry. From price wars to economic slowdowns and record-high inventories, the oil industry faces a critical juncture. But here's where it gets controversial. The impact of these challenges may not be fully understood or anticipated. The oil tsunami, a triple threat. The oil markets are navigating a treacherous path, facing three significant challenges in the coming months. OPEC Plus versus US shale producers. A new price war has commenced, with OPEC Plus aiming to protect its market share, a move that could have far-reaching consequences for global oil prices. Economic slowdown. President Trump's trade war has contributed to a global economic slowdown, impacting the U.S. and potentially reducing oil demand. Record-high inventories. Oil stocks are reaching near-record levels at sea and in China, as shown by the Bloomberg data. This surplus could lead to a glut in the market. Technicals bearish, prices in decline. The technicals, widely followed by hedge funds, indicate a bearish market. Brent crude oil prices have been steadily declining since March, falling out of their triangle formation, a reliable indicator of market trends. As one expert notes, the triangle highlights the battle between bulls and bears, and when one side wins, prices often move significantly. Inventory buildup. China and the seas. China has been rapidly expanding its oil storage, aiming for a massive 1 billion barrels, while the U.S. stands at 404 million barrels. This buildup, as reported by Reuters, supports prices as OPEC Plus producers reduce production cuts. Meanwhile, oil in transit has climbed to record levels, as per Bloomberg, with the total amount reaching 1.2 billion barrels. Lower prices forecasted. Even the U.S. Energy Information Administration, EIA, expects prices to fall, forecasting an average Brent crude oil price of $62 per barrel in Q4 2025 and $52 per barrel in 2026. This is due to the expected rise in global oil inventories, putting downward pressure on prices. OPEC's challenge, non-OPEC plus supply growth. The International Energy Agency, IEA, highlights the challenge for OPEC, with non-OPEC plus oil supply growth remaining strong. Countries like the U.S., Brazil, Canada, Guyana, and Argentina are producing at or near record highs. This surge in supply, coupled with OPEC's planned increase, could lead to an oversupply situation. Storing oil, a costly venture. While storing oil is beneficial for ship owners, it's more expensive now due to higher interest rates. Traders need prices to fall into contango, where today's prices are lower than future delivery prices to afford storage. The Gaza peace deal and potential nuclear deal with Iran could further impact oil prices and reduce tensions in the Middle East, adding to the market's uncertainty. Reduced demand and destocking. Falling prices are leading to reduced short-term demand as companies destock down the value chain. The trade war has already weakened demand in Q4, and destocking could further impact the market in the lead-up to Christmas. The oil market's future is uncertain, and these challenges could have a significant impact. What do you think? Will the oil market weather this storm, or are we headed for a tsunami of consequences? Share your thoughts in the comments.